Let's take a look here at the 2016 macro long FRQ question number 1. Okay, there we go. So this question is going to start out with the Phillips curve, and then we're going to go from there. So let's just use a screen sketch. Okay, assume the United States economy is currently in a short-run equilibrium with the actual unemployment rate above the NRU, above the natural. So that's important to locate, pay attention to. Let's go to part A. Draw a single correctly labeled graph with both the long-run Phillips curve and short-run Phillips curve, and then they don't give us any values in terms of what unemployment or inflation are. But we're just going to label where we are on the sort of generic graph. Okay, so Phillips curve graph, let's just do it down here. Okay, so we have the inflation rate here, unemployment rate down here. All right, so in the short run Phillips curve, right, there is a trade-off, downward trade-off. So we're going to say short run Phillips curve there. In the long run, there is no relationship, right? So the long run curve is vertical, long run Phillips curve. And at this point, right, they don't give it to us, but it would be the natural rate of unemployment down here. I don't think you have to specifically label that, but you do need to know the relationship because they want the current point P. So they give us an actual unemployment rate that is above the natural rate of unemployment. So to label our point, we know unemployment has to be somewhere above and beyond the NRU, right? So knowing that the NRU is where the long-run Phillips curve intersects is necessary to this question. So then you would draw some point off to the right on the curve here. We're going to label that point P. And you know, they didn't give us any actual values, but you know, if we figure this out, the unemployment rate would, in this case, be above the natural rate of unemployment, and inflation rate would be somewhere over here. So that's essentially what you had to do for part A. Just sort of draw the generic Phillips curve graph there. All right, part B. Assuming no policy actions are taken, will the short-run Phillips curve shift to the right, shift to the left, or remain the same in the long run? And then explain. So we want to know what's going to happen to the short-run Phillips curve. I think the best way to approach this is to think about what's going on in the ADAS model, because we know that the Phillips curve, a shift in aggregate demand is a movement along the short-run Phillips curve, right? Moving either back this way or this way due to a shift in aggregate demand. A shift in short-run aggregate supply is a shift of the curve, of the Phillips curve, either rightward or leftward. And that shift is going to be in the opposite direction of whatever's going on with short-run aggregate supply. So it's difficult to answer this question without sort of drawing or sketching out on the side. And again, you do need to explain. So it's good to fully understand what's going on here. So I'm going to go back, sketch out an ADAS model. You know, we've got price level, we've got real GDP. All right, so let's draw. So we've got short run aggregate supply and aggregate demand. All right, but we also need to draw an LRAS curve, right? So if we go back to our beginning, we're in short run equilibrium, but we've got actual unemployment rate above the natural rate of unemployment. So if we were going to draw this on this model, right, we are somewhere below full output, right? So our LRAS curve is here. This is our full output level, and we know that we're below that, somewhere below that, because we said unemployment is higher than the natural rate of unemployment. So this, if we're going to draw the ADAS model, this is something what it would look like. Now, to get to the answer to part B, we need to figure out what's going to happen to this model given no policy actions, right? So government is not spending. There's no fiscal stimulus. There's no monetary spending, sorry, monetary policy changes. So what happens to this with no government intervention, right? Well, in the long run, you get this secondary shift of the short run aggregate supply curve, right? And the reason being is that when you're below, right, it lowers input costs, nominal wages, and eventually that feeds through to a gradual shift back of the short run aggregate supply curve, where you end up back on the full employment level, but you end up, coming down this way in terms of the price level. So that, hence recessionary gap, right? All right, so what does that mean in terms of the Phillips curve? Well, we just mentioned a shift in aggregate demand is movement along the Phillips curve. We don't have that here. What we drew was not a shift in aggregate demand, right? Government intervention would try to shift aggregate demand, but we didn't have that. So we have a movement of the short run aggregate supply curve, and we have a shift toward right of the short run aggregate supply curve. So we know that the Phillips curve does respond with a shift in response to shifts in short run aggregate supply. And then the question is which direction? So the direction is in the opposite, right? So if short run aggregate supply is shifting right, we're going to have a short run Phillips curve shifting left. So we don't technically need to draw another graph here for this, or even show it on the previous graph, but shift to the left should be your answer there. But your explanation should have something to do with, okay, well, short run aggregate supply is shifting, and short run Phillips curve responds with a shift, but in the opposite direction. So a rightward shift in the short run aggregate supply is a leftward shift like this in short run Phillips curve. And if it were flipped the other way, then it would be going in the other direction. Sort of a tricky question to be able to fully justify there, but you really ought to understand what's going on and what causes and what direction the Phillips curve moves in response to what's going on over here. All right, so let's move on to part C. If the Federal Reserve Bank wants to lower unemployment, what expansionary open market operations should it use? Okay, so really the question here is what when the Federal Reserve Bank is having an expansionary policy, open market operation is always talking about bonds, right? Should we buy them? Should we sell them? And what that does to the money supply. So think expansionary. Expansionary equals we need the money supply to increase. So we need to put essentially more money on bank balance sheets to feed through the money multiplier. So we are going to buy bonds. So the Federal Reserve is buying bonds, right? They're taking bonds off the balance sheet of the banks, paying them cash for those bonds, right? So that extra cash is going to go into excess reserves. And then those banks are free to lend that out, right? And expand the money supply. So buy bonds is the explanation, the answer for part C. And you really don't need to add any more than that. You just need to know which policy is expansionary, which one's contractionary. Okay. Let's go to part D. Okay, how will the open market operation you identified in part C affect each of the following? Federal funds rate, explain, and then real interest rate in the short run. And there's no explanation for that one. So let's think about the money market graph and then the loanable funds graph. And part two is actually interesting to think about because you could sort of make an argument the other way. But all right, federal funds rate. So what did we say? So we've got interest rates here. We've got quantity of money down here and money supply. So we're just going to sketch this out, what's going on, right? If we increase the money supply, which is what we just talked about, expansionary policy, right? They're going to buy bonds, which is going to increase the money supply. So we're going to go this way. What does that do to rates, right? Interest rates, federal funds rate, all that stuff is going to decrease right here. You see that on that graph. So, Fed funds rate decreases due to money supply increase. You know, something of that effect would be pretty good for an explanation. If you wanted to sketch out this graph, you know, just to be clear that you were showing that effect, and be sure as to what's going on. All right, real interest rates in the short run. So this is interesting. I think interest rates, we can say, you know, we obviously saw due to the money supply, interest rates are going to decrease. There's an interesting argument to be made. You know, if you go back, all right, so let's redraw this graph down here, right? Okay, so we had short run aggregate supply, aggregate demand. We were in a recessionary gap, right? LRAS. Okay, so what this expansionary monetary policy is supposed to do is shift aggregate demand out that way, right? Rightward, and that's through, you know, increasing interest rate sensitive, you know, consumption and investment, all those components, right? So what you see here through this policy, let's call this PL1, let's call this PL2. So what you notice is that the price level did increase, right? So you're talking about it should be some amount of inflation resulting from this policy. So because this says short run, I think we're safe with our answer. Okay, all interest rates are going to decrease in the short run. But it's interesting to think about, you know, if you're going to integrate, if it said long run or if it just said real interest rate, you could kind of make an argument that, well, okay, inflation is increasing, right? We don't know by what factor, but we can certainly say that the effect is positive inflation. And if that's high enough to impact the loanable funds market, right? People are expecting higher levels of inflation. They're going to integrate that into their real interest rate equations, right? Remember, real interest rate is nominal plus the inflation rate. So if this effect down here is big enough, and if this was, you know, not specified that it's specifically a short run, I think you could make an argument that said, well, the real interest rate might actually maybe increase, right? If this effect was large enough such that inflation was higher than expectations, and then that fed through into the real interest rates. But I think because they have short run in here, it's essentially, you know, you think about it in this terms, that effect outweighs any effect you get down here. But it's an interesting question that could be argued in a different way if it was worded slightly differently. Okay, part E. Given your answer in part D2, what is the effect on real gross domestic product in the short run? Again, you know, I think it's so important that they're specifying short run, so they don't want us to get you know, cute with those sort of fancy secondary and tertiary effects. So short run, we answered interest rates are going to decrease. You know, you got to explain here. So interest rate decreasing, you should say something about, you know, interest rate sensitive components of GDP are going to increase. So, you know, consumption is going to go up, investment's going to go up, for sure, those two, and probably net exports as well. But the one thing that we can say is that aggregate demand, right, another word for real GDP, is going to increase. So that's sort of the you know, the reason the Fed is implementing whatever policy it's trying to do, trying to stimulate aggregate demand. So some sort of explanation with this sort of logic, interest rates, and then these interest rate sensitive components increasing, thereby stimulating aggregate demand and increasing real GDP. All right, F and G are talking about foreign exchange market. Let's get a little bit of space down over here. Okay, Japan and the United States are major trading partners. Indicate how the change in real GDP you identified in Part E will affect the demand for Japanese yen in the foreign exchange market. Okay, so increase in real GDP, right? Stimulating aggregate demand stimulates demand for imports, right? So when you're talking about a foreign currency, in this case, we're talking about Japan, demand for yen is going to increase. And we're going to kind of show that effect in part G. So F really just wanted us to show the effect, so either positive or negative or no change. So that's really all we need for part F. Part G, now draw a correctly labeled graph of the foreign exchange market for the Japanese yen, showing the effect of this change in demand on the value. Okay, so we need to draw our foreign exchange market graph. Okay, so up here, our price is dollar yen, and down here is going to be, quantity of yen. All right, so we start with a supply and demand curve, or sort of initial equilibrium. Quantity, all right, here's our initial exchange rate. And what we just said in part F, this change that's going on is going to increase demand for Japanese yen. So we got to shift out that way. We have our new quantity, but more importantly, we have our exchange rate too. So what we see here and what we've shown is that the increase in demand is going to cause yen to appreciate. Prices increasing.